what is discounted cash flow, and how to get started on building a DCF model. A big part of what the discounted cash flow method is all about is right there in the name. It involves estimating future cash flows and discounting or translating them to today's equivalent. A lot of people use the DCF method in order to decide whether to buy, sell, or hold a share of a publicly listed company. Your first steps into using discounted cash flow can be fairly easy. Here's some good news. If you understand the concept of present value, then it will be easy to understand discounted cash flow. If I promise to pay you $100 today, but give you the choice of receiving that money right now or a higher amount of money 1 year from now, and both the option of $100 today or $110 1 year from now are equally attractive to you, then we have figured out the time value of money. More formally, you would say that the discount rate or rate of return is 10%. The future value of $100 at a rate of return of 10% is $110. The present value of $110 using a discount rate of 10% is $100. Here's my definition of the DCF method. An attempt to estimate the value of a share today based on projections of how much cash the company could generate in the future. You can also perform a discounted cash flow analysis on the level of the company itself, or on the level of a single investment. Now, in my definition of the DCF method, there are a few tentative words: attempt, estimate, projections, could. Why should we be careful with the discounted cash flow method? Because it involves predicting the future, and that future has not happened yet. Well done, Sherlock. Nice that you figured that one out. No, wait. The point is that the future will be much weirder than we can imagine. The big unexpected events are the things that shape the world, and those are not included in forecasts simply because, by definition, you can't predict them. That's why after the fact, you hear so many forecasters and predictors utter phrases like, "That wasn't in the model," "Nobody could have forecasted that," or a variation on that theme. So be careful not to worship your DCF model as the one and only possible outcome, because it's absolutely not a certainty that reality will follow your forecasts. In discounted cash flow modeling, you have some important choices to make. You can keep it very simple, or make it very complex, or anywhere in between. If you keep it simple, you and a calculator can easily do the job. If you want to go complex, you'll need a sizable Excel file. Let's do both in this video, in a discounted cash flow case study of Verizon Telecom. Come look over my shoulder as I go through various methods and calculations and interpret the numbers. The nice thing about keeping your DCF modeling simple is that you don't need a deep knowledge of the company, its financial statements, or finance and accounting terminology in general. The big risk is obviously that you might underestimate the company's complexity and dynamics. Most people go in the direction of complexity, which might look and feel more impressive, but is dangerous if you lack clear thinking skills and are unable to see the big picture. If you have hundreds of line items, your discounted cash flow model, do you really understand which of those are the high impact ones? It's easy to get lost in spreadsheet complexity, with numbers not tying out or formulas incomplete. Only go complex when you're able to handle it. There are basically three elements that you need to make a choice on: discount rate, number of line items in your model, and the number of forecasting periods. Each of these has a simple version and a complex version, and options in between. For discount rate, there is the complex DIY, do-it-yourself option, or the simple internet search option. For the number of line items in the model, you can have lots, and I mean lots, or boil it down to just one single item. For the number of forecasting periods, you can go to 5, 10, 15, or even 20, or just one. Let's walk through and apply each of these. Here are some rules of thumb for the discount rate. For companies listed on the stock market, use 6 to 9% if you think they are relatively stable, mature, proven, predictable, robust. 10% for the average company, the middle of the pack. 11 to 15% for companies that are not very stable, not very mature, basically the opposite of the first category. And then for startups, anywhere 20% and above. I have heard of venture capitalists using 30%, 50%, or even 70% for very early stage companies, pre-product, pre-revenue. With high discount rates like that, the potential future cash flows need to be very attractive for the present value equivalents to be of any significance. The technical term for a discount rate in a DCF model is WACC, weighted average cost of capital. WACC is a calculation of a firm's cost of capital in which each category of capital is proportionally weighted. WACC equals the market value of a firm's debt divided by the market value of both debt and equity times the cost of debt, plus the market value of a firm's equity divided by the market value of both debt and equity times the cost of equity. Particularly that last part, the cost of equity, is labor intensive to calculate and very questionable in terms of intellectual rigor. So why not go the easy way? Go through an internet search and see if we can find a suitable WACC for the telecom industry, which our case study company Verizon is in. Exercise some judgment when going through the search results. Abraham Lincoln is rumored to have said, "Don't believe everything you read on the internet." So try to distinguish between respectable and questionable sources of information, and beware that different sources might give you contradicting messages. Here's a WACC estimate made by a consulting company in Europe. They give a bandwidth, an average, and show the development of the WACC over time. Around 6% seems to be a solid number for the industry, according to them. If we specifically look for a WACC for Verizon, at least two sources give you a number and the underlying assumptions. To be on the cautious side, let's round up to 7%. Next up is the number of line items in our DCF model. If you want just one line item to forecast, then stick with just the end goal of any discounted cash flow analysis, the free cash flow of the company. Free cash flow is the cash flow not required for operations or reinvestment. In other words, the cash flow available for distribution among all the securities holders, debt or equity of an organization. At the time of making this video, the free cash flow for Verizon in the latest financial year was $18.7 billion. 1, 8, 7, and then 8 zeros. That's a lot of free cash flow. The two high-level components going into free cash flow are cash flow from operations and capital expenditures. In the case of Verizon, $37.5 billion of cash flow from operations, with half of that, $18.8 billion, getting reinvested into the business through capital expenditures, which leaves $18.7 billion in free cash flow. A three-line item DCF model would have those rows in there. If you want to expand your model, then dive into the things that influence cash flow from operations: revenue, operating expenses, interest expense, corporate income taxes, non-cash charges, and a few more. And if you want to go even deeper, analyze and model especially the factors driving revenue. This will make your discounted cash flow model both more sophisticated as well as more complex. Number of forecasting periods. Usually in an Excel DCF model, people would forecast for 5 or 10 individual years and then calculate a terminal value for the future beyond those 5 or 10 years. If you want to keep it very simple, you could just focus on 1 year through a mathematical shortcut called the present value of a perpetuity. Now that you are aware of the choices available to you, let's go through how to use discounted cash flow in the simplest way possible, taking the discount rate from an internet search, using just the ultimate output variable of free cash flow, and taking this for 1 year. Here's how the simplest discounted cash flow analysis works. Use the formula for the present value of a perpetuity. What if the latest actual free cash flow that was realized continues from now to eternity? Take the free cash flow in the numerator and divide it by the discount rate in the denominator. Using the numbers in our Verizon DCF case study, $18.7 billion divided by 7%, which is $18.7 billion divided by 0.07. Punch that into your calculator and out comes $267 billion. This outcome is what is commonly called the enterprise value of the company. In the simplest version of the subsequent calculation, you add cash and cash equivalents, the money that the company already has in the bank, and deduct the debt, how much the company has borrowed. Both of these numbers can be found on the latest balance sheet of the company. The outcome of that is the equity value, the amount of money that all of the shares in the company combined should be worth according to your calculation. In this estimate, the equity value is $119 billion. Divide the equity value by the number of shares, in the case of Verizon, currently 4.2 billion shares, you get a DCF valuation target share price of $28. On purpose, to emphasize its tentative nature, I'm using the approximately equal to instead of the equal sign in these calculations. And I round the DCF valuation of the share price to a full dollar number, no decimals, to avoid being misleadingly precise. A variation on this DCF analysis shortcut, still fairly simple, is to take an estimate current year free cash flow rather than the actual free cash flow of last year. We know the prior year values for the two high-level components going into free cash flow, and we can combine this with insight from the company's guidance on the current year. Verizon provides guidance on 5 financial metrics, 2 of which are relevant for this part of our analysis. The growth in EBITDA can be used as a proxy for growth in cash flow from operations, and the expected capital expenditures are listed as a separate item. Let's take the middle of the range for both of these. So our estimate for 2024 for cash flow from operations is for this to grow by 2% to $38.3 billion, and for capital expenditures to decline to $17.3 billion, which would put 2024 free cash flow at around $21 billion. Cash flow from operations slightly up and capital expenditures down would lead to free cash flow growing double digits, more than 10%. Plug this new free cash flow number into the present value of a perpetuity calculation. $21 billion divided by 0.07 is a potential enterprise value of $300 billion. Same steps as before. Enterprise value plus cash minus debt gives us a potential equity value. Equity value divided by number of shares provides a DCF target share price of $36. That's $8 more than if we base our calculation on last year's free cash flow. We can also take that $21 billion forecasted free cash flow for the current year and plug it into a slightly adapted version of the formula, called the present value of a growing perpetuity. Free cash flow divided by discount rate minus growth rate. $21 billion divided by 7% minus 2%, or $21 billion dividing by 0.05. This provides a potential enterprise value of $420 billion. If you go through the usual steps from enterprise value to equity value to DCF valuation share price, you will get to $65 per share, a whopping $29 more than what we just calculated before. Let me summarize the outcomes of these 3 simple discounted cash flow calculations. The present value of a perpetuity applied to prior year actual free cash flow, the present value of a perpetuity applied to current year estimated free cash flow, and the present value of a growing perpetuity applied to current year estimated free cash flow. The enterprise value goes up by 12% when moving from option 1 to option 2, and 40% when moving from option 2 to option 3. The equity value goes up by much more, 28% and 79%. Why is that? Well, you add cash and deduct debt, which are absolute amounts. Therefore, even though enterprise value and equity value grow by the same amount, the percentage change will be far more dramatic for equity value. The estimated DCF target share price goes up by the same percentages of 28% and 79% respectively, as this is simply the equity value divided by the same number of shares of 4.2 billion. So far, so good. So what? Here's the section most of you have been waiting for. Let's build a DCF model in Excel. Remember, you always have a choice. Choose a level of complexity that is manageable for you to build a discounted cash flow model. I'm not going all out by forecasting a full P&L, a full balance sheet and a full cash flow statement, but instead I just focus on the P&L and the first part of the cash flow statement until the free cash flow line. What I'm going to show you is how to build a discounted cash flow model in Excel from scratch, using the discount rate from the internet search, incorporating a lot of line items, but by far not the maximum number possible, and working on 5 forecasting periods and a terminal value. So where do you even start when you want to build a DCF model in Excel? First step is to load, analyze and understand historical data. This can help you understand the drivers of the business, trends and expected ranges for certain parameters. Probably the most useful part of building a discounted cash flow model is getting a deeper understanding of the company. You really need to put the work in to get that understanding, but it can be very fulfilling and rewarding. At least that's the way I feel about it. Once that first step is done, you next review and incorporate the company's guidance. Forecast each line item in a solid and prudent way, and zoom out to make sense of the big picture. Here we go. We are going to make a journey from revenue to net income, from net income to cash from operating activities, and from CFOA to free cash flow. And I will provide you some very practical tips along the way. Historical revenue data. I've put in 3 years of history. 5 might be even better and more insightful. But then again, there was no download available of the company's financials, so I opted to minimize the amount of manual data input. My DCF model works from left to right. Oldest year on the left, latest year on the right. For the years where I have historical actual data, I put an A next to the year. Once we get to forecasting future years, I will put an E for estimate next to the year. The Verizon income statement for external reporting has 2 revenue lines, and I will follow that format in my discounted cash flow model. If you want to dive a lot deeper into revenue, you could follow Verizon's reportable segment structure of consumer versus business and go into a more granular level of data regarding connections, net additions, churn rate and account statistics. Be my guest. Let's take a first look at the total revenue numbers. Nearly $134 billion in 2021, then an increase in 2022 to $137 billion, followed by a decrease in 2023 back to $134 billion. A big part of that can be explained by the dynamics in the wireless equipment services line. 2022 seems to have been a year where customers upgraded their device or added devices to their household as equipment revenue peaked. If you look at the service revenue line, Verizon seems to be a flatlining business. But are we really comparing apples to apples? If you dive into the 10K annual report, item 7, management discussion and analysis of financial condition and results of operations, section acquisitions and divestitures, you will find some significant changes. First of all, the sale of Verizon Media was completed on September 1st, 2021. The 2021 results include $5.3 billion revenue for the 8 months that this segment was still part of the company, but that revenue obviously does not recur in subsequent years. Second, the acquisition of TracFone was completed November 23rd, 2021, which added around $4.8 billion in revenue for 2022. So in this case, those 2 deals are pretty much a wash. They cancel each other out as far as the revenue line is concerned. But it is worth checking for changes in consolidation, acquisitions or divestments, for the company that you are building a DCF model for. After this high-level review of revenue, it's time to incorporate the cost of services sold and the cost of wireless equipment sold, and then calculate gross profit by deducting those costs from revenue. The way I prefer to look at this is on a relative basis. What is the gross margin percentage if we divide gross profit dollars by revenue dollars? This is where we have our first wow moment. Services are hugely profitable, while the equipment sales are running at a loss. A clear case of a razor and blades, printer and toner, or hardware and services business model. If we translate those terms to the telecom industry, aggressive device promotions to encourage customers to switch carriers, as well as retain existing customers. Equipment at a loss drives services at high margins. What do we learn from the gross margin analysis? Revenue mix is important, as there can be very different gross margin percentages for each business. On to selling, general and administrative expenses, in short SG&A, another major cost line in Verizon's P&L. This is a tricky one, as there are parts of SG&A that are recurring and can be used for a trend analysis, and other parts that are supposed to be non-recurring special items. There's a table listing the special items in item 7 of the 10K report, and it's fairly easy to add up those items that impact SG&A. Some years, it's just one line item. Other years, it might be 5. Now that the special items in SG&A are isolated, we can calculate core SG&A as a percentage of revenue and get to a pretty consistent 22% to 23% of revenue, which we can then use in our forecasting exercise for future years. Next up is depreciation and amortization expense. This isn't usually split out separately in a company's profit and loss statement, but Verizon does so as it is such a large material amount of expense for them. We see a steady increase in depreciation and amortization, which is largely related to the step up in CapEx spending in the past few years, which we will get to later on. 2023 had a large charge in the income statement related to goodwill impairment. This one-off non-cash expense significantly impacted 2023 results as far as profitability is concerned. Total operating expenses is a subtotal that adds up the cost of services and equipment sold, SG&A, depreciation and amortization, and the goodwill impairment. At first sight, this looks like a trend, adding about $5 billion in cost per year. But this subtotal is heavily influenced by one-offs. More equipment revenue in 2022, which lowered the gross margin percentage, and goodwill impairment in 2023. In order to decide if there is a trend or no trend, you have to understand what the special items are in the P&L. We now get to a very important metric, operating income. If revenue has been essentially flat and operating expenses have gone up, then operating income declines. Operating income as a percentage of revenue gives you a really good way to compare and benchmark companies and to follow the profitability trends over time. From operating income, it's only a short way to net income. First off, other income. Income that does not come from a company's main line of business. Just like in selling, general and administrative expenses, there are a lot of special items included in this line that make the total other income swing up or down significantly. Once those special items are separated out, the core other income seems to be consistently a small positive number for the company. Interest expense is a very relevant expense line for a company with over $150 billion in debt on its balance sheet. Interest rates in the markets have been going up in 2022 and 2023, which will have a delayed effect on Verizon's interest expense, as much of their debt is very long-term in terms of maturity and fixed rate in nature. If you dive into the details in the annual report, you will find that interest expense in the P&L is influenced by the amount of debt outstanding, interest rates, maturities, hedges, and the capitalization of interest. Income before provision for income taxes is also known as pre-tax profit. Below that line is the provision for income taxes. Once you know those two numbers, you can calculate a key value for any DCF analysis, the effective tax rate. This effective tax rate can be higher or much lower than the statutory tax rate, so it's worth reviewing what drives it. For example, the effective tax rate jumped in 2023 as the goodwill impairment charge is not tax deductible. So the 2021-2022 effective tax rate is much more representative. The effective tax rate can be very company specific, so always review it for the company that you are modeling rather than just relying on a generic rate. Net income, or the bottom line, gets us to the end of the income statement. Just like operating income, net income has been going down, and expressing net income as a percentage of revenue gives you a nice high-level insight to the profitability of the company. The next section of the DCF model is something that might feel unfamiliar to a lot of people. You have to study the cash flow statement, more specifically, the indirect method of cash flow reporting, in order to understand this important section. Cash from operating activities is different from net income, as things are measured on a cash basis, not on an accrual basis. Therefore, non-cash adjustments are needed to get from the one to the other. The first and most obvious, and in case of Verizon by far the largest item, is depreciation and amortization. In the income statement, you deducted depreciation and amortization as an expense, which lowers the pre-tax income and the provision for income taxes. Now you add it back, as depreciation and amortization are not paid to anybody. They are a non-cash expense. So if you deducted them first, in order to get to the correct operating income and net income, you'll have to add back the same amount in this section to get back to zero. Next are 4 lines of adjustments where the timing of recording the expense and the timing of actual cash outflows are different. In most cases, the cash payments happen later, or possibly not at all. Numbers between brackets are cash outflows, the others are cash inflows. For example, as an incentive for companies to invest, governments often allow companies to depreciate assets on an accelerated basis for tax purposes. This postpones the actual payment of some of the corporate taxes in time, hence an inflow from deferred taxes. Changes in current assets and current liabilities is the sum of 4 line items related to working capital. The change in accounts receivable, in inventories, in prepaid expenses, in accounts payable and other such current assets and liabilities. If cash gets stuck in working capital rather than flowing into the bank account, then this is showing between brackets as a cash outflow. Last is the line called Other. Recurring items in this category, specifically for Verizon, are changes in device payment plan agreement non-current receivables, as well as net debt extinguishment losses. Those are not the types of line items I look at or think about on a frequent basis, if at all. The sum of the adjustments from net income to cash from operating activities is large, mostly due to adding back depreciation and amortization. CFOA is the next important subtotal in our DCF model. Only capital expenditures are left before we get to the end goal of the free cash flow line. Let's not rush this one, as it's a very large number in this discounted cash flow model. For our 3 years of historical data, CapEx is increasing and then decreasing. It's hard to detect a pattern here initially, so let's expand our view to the last decade. If you look at the longer term trend, you see that $17 billion to $18 billion has been the usual range of CapEx spending for Verizon. So 2021 and 2022 were unusually high years, and 2023 is somewhat back to normal. If you dig into the investment spending, you will see that 2021 and 2022 were peak investment years for many US telecom companies due to the rollout of the 5G network. Given how much money is involved here and the direct impact of CapEx spending on free cash flow, it's important to dig deep here. Cash from operating activities minus capital expenditures equals free cash flow. At this point, check that what is in your Excel DCF model is the same as what is in the company's 10K annual report. If that's the case, then it's time to start the forecasting part of the discounted cash flow model. Steps 2, 3, and 4 are actually done simultaneously. And to put some context around step number 2, review and incorporate the company's guidance doesn't mean we take each and every number the company gives us at face value. It's okay to challenge these and possibly disagree if you feel you have good reasons to do so. We will work through the DCF model in the same way as we did with the historical actuals, from revenue to net income, from net income to cash from operating activities, and from CFOA to free cash flow. For the forecast columns, the year is indicated with an E for estimate. Throughout the file, all input cells are marked in yellow. The other cells are calculated values. For revenue growth, I have taken the 2024 guidance issued by the company and applied the higher end of the range for the first 3 years, and then the lower end of the range for the last 2 years. 2% long-term growth rate is also in line with the long-term growth expectation of the US economy. The shortcut that I'm taking here is that the guidance is for wireless service growth, while I assume that the wireless equipment revenues grow at a similar rate, even though we know that these upgrades, replacements, and device additions are more of a lumpy business. For gross margin percentage, I chose to keep that constant at the 2023 levels. Yes, there is upside potential, as Verizon has leadership in both the 4G and the 5G networks. Consumers are migrating to higher price plans, and Verizon could implement targeted pricing actions to increase the margins. On the other hand, there is downside potential as well, as the telecom industry is highly competitive. The threat of a price war is never far away. Verizon operates in a market which already has a very high penetration of smartphones, and new technologies and new entrants could disrupt the industry and drive margins down. Many of these factors are discussed in more detail in sections 1A, Risk Factors, and 7, Management Discussion and Analysis of the 10K Annual Report. SG&A. I am keeping core SG&A stable at 23% of revenue, so if revenue goes up, then SG&A goes up at a similar rate. The causality is actually the other way around. More SG&A spending, for example to increase advertising, should drive revenue growth. But the model doesn't care about that. Special items could go either way, positive or negative, so for forecasting purposes, let's keep these at 0. Depreciation and amortization. As a lot of the CapEx spending over the past few years was for assets that were work in progress that are subsequently put into active use, it is likely that depreciation expense will go up. Amortization of intangible assets is going up as well. I assume that the increase from 2022 to 2023 is recurring. $500 million of increase per year. And if this depreciation and amortization forecast is off, then remember that you add back exactly the same amount in the non-cash adjustments further down. The main financial impact on the DCF model is that depreciation and amortization is a tax-deductible expense. So the higher the depreciation and amortization, the lower the provision for income taxes. Goodwill impairment. Let's assume this is not recurring. Operating income as percentage of revenue. This is not an input, but a very important outcome to check. An operating income of 23% of revenue is in line with the 2021-2022 actuals. So I don't think the forecast is overly aggressive here. For other income, I assume that the lowest number of the past few years, $600 million of income, continues in each of the years of the forecasting period. No special items. Interest expense. A tough one to forecast, given how many factors play into this. For example, the more free cash flow the company generates, the more opportunity they have to pay down debt, which could have a big effect on interest expense. And who knows where interest rates will go after more than a decade of interest rates being artificially low and then rising much faster than expected. My shortcut here is to take the actual number from the latest quarter, which when making this video is Q4 of 2023, and annualizing that. 4 times $1.6 billion is $6.4 billion. I'm keeping that amount the same over the forecasting period. Forecasting the effective tax rate. Putting in 23% for the 5 years in the forecasting period is supported from two sides: the historical effective tax rate and the company's guidance. Net income as percentage of revenue. Just like the operating income percentage, this is not an input, but a very important outcome to check. At 14 to 15% of revenue, this is lower than the 2021-2022 actuals. So once again, I don't think the forecast looks overly aggressive here. Forecasting the adjustments from net income to cash from operating activities is an area where you have to be cautious, just when forecasting fatigue might be setting in. The first line item is easy. You add back depreciation and amortization that was deducted previously in order to get to operating income and net income. But the other line items are not so straightforward. The non-cash impact of employee retirement benefits, a use of cash, a negative number in 21 and 22, and a source of cash, positive number in 23. Lacking any further information, I have input 0 for all the years in our forecasting period. Impact of the increase or decrease of the deferred income taxes balance. Very favorable in the past 3 years, mostly related to the purchase of wireless licenses and the CapEx spend, but far lower, yet still favorable, in the years prior to that. Something I found in the archive of Verizon 10K annual reports. Let's be prudent and take $2 billion of positive impact per year. The impact of the provision for expended credit losses. According to the annual report, collections have returned to pre-pandemic levels. At $1.5 billion positive impact per year, I'm taking the average of the 2021-2023 time period, which also matches the 2019 levels. As we have discussed when forecasting the income statement, let's assume the goodwill impairment is non-recurring. Changes in the current assets and current liabilities. In other words, the effect of changes in working capital. When revenue is growing, working capital tends to increase as well. Therefore, let's assume a use of cash here of $500 million per year, in line with the average of 2021 through 2023. The other line. A bit of a cryptic category, yet we do have to input a number. Recurring items in this category are changes in device payment plan agreement non-current receivables, as well as net debt extinguishment losses. As for the second one, net debt extinguishment losses, this is related to refinancing debt when interest rates are going down. And those days seem to be over, as interest rates have risen and seem to be stabilizing. For changes in device payment plan agreement non-current receivables, I'm taking the average of the last 5 years, 2019 through 2023, and putting this at $2 billion cash outflow per year. After all those adjustments, we can now review the cash from operating activities line. How can we judge whether the growth in CFOA makes sense? By comparing it to where we started our forecasting effort, the revenue line. I put the revenue growth at 3% to start with, and then slowing to 2% growth per year. As a result of the revenue growth and all the other line items forecasted, cash from operating activities is expected to grow by 4% at first and then dropping to 3% and 2% in later years. That seems to be very well aligned. Capital expenditures forecasting. Fairly easy for 2024, as Verizon provides guidance in this area, and they probably have a very accurate picture of the spending well in advance of the actual construction. For the outer years, I assume that CapEx spending has to grow in line with revenue in order to support the company's market position. And here we are, a free cash flow estimate for each of the 5 coming years, slightly ahead of the $21 billion that we forecasted for 2024 in our shortcut approach earlier, and growing in line with revenue in the years thereafter. The 16% forecasted free cash flow growth versus prior year in 2024 is a one-off, the result of 4% forecasted CFOA growth and a 7% decline in CapEx spending, now that the peak investment years have passed. Let's translate the free cash flow estimates into a DCF valuation target share price. We continue to use the 7% WACC that we used earlier. First, we calculate the present value of the free cash flows in the 5-year forecasting period. Here's how that works. The free cash flow estimates in the valuation are linked one-to-one with the free cash flows in the forecasting model above. To these, we have to apply discount factors. The further out in the future the free cash flow occurs, the lower the present value will be. The discount factor is 1 plus the WACC to the power of the number of years. So 1.07 for year 1, 1.07 times 1.07 for year 2, and so on. The further out into the future, the higher the discount factor. Now divide the estimated free cash flows in row 71 by the discount factors in row 72. $21.7 billion divided by 1.07. $22.4 billion divided by 1.14, and so on. Those 5 numbers you can then sum to get to the present value of the free cash flows in the forecasting period of $94 billion. That's one way to do it. Kind of the long way around, but it's very clear what the steps are. The other way to do it is to use the NPV formula in Excel. NPV of B68 applied to E71 through I71. B68 is the cell in our Excel worksheet where the WACC is located. E71 through I71 contain the nominal, undiscounted free cash flow numbers. Guess what? Using this formula also gets us to $94 billion. It might seem like a duplication of effort to calculate this in 2 ways, but it's only a small investment of time and effort versus the huge consequences of having formula errors in your DCF model. Check, check, double check. Next, we calculate something called the terminal value. This is something we have done earlier on in our discounted cash flow shortcuts, when we talked about the present value of a growing perpetuity. What is the estimated value of the free cash flows of the company for the time periods after your last projected year, all the way until the end of time? You start with calculating the free cash flow input for the terminal value, which is usually done by taking the free cash flow in the last year of the forecasting period and multiplying it by the terminal value growth rate. $24.3 billion times 1.02 is $24.8 billion. To translate that single free cash flow number to the terminal value beyond year 5 all the way to eternity, you divide by the WACC minus the growth rate. In our case, $24.8 billion divided by 0.07 minus 0.02. This works out to be a momentous number of $495 billion. However, that's the estimated terminal value in 2028, 5 years from now. That amount needs to be brought back to today's equivalent as well. $495.5 billion divided by 1.4 equals $353 billion. Now we can add up the present value of the free cash flows in the 5-year forecasting period and the present value of the terminal value. This leads to an estimated enterprise value of $447 billion. Nearly 80% of that enterprise value is driven by the terminal value, which is an unusually high percentage, even for a 5-year forecasting period. Much of this is driven by the relatively low WACC of only 7%. If the WACC were higher, then both the enterprise value as well as the impact of the terminal value on the total would be much lower. If the forecasting period is longer, for example 10 years instead of 5 years, then the enterprise value outcome might be similar, but the terminal value as percentage of the total would be lower, as more of the future lies within the forecasting period. Enterprise value to equity value. Take the enterprise value we calculated, add cash and cash equivalents, deduct debt, and we get to an estimated equity value of nearly $299 billion. That equity value divided by 4.2 billion shares equals a target value of the share of $71. If we add this value to our table that we started earlier, we have now added the highest estimated share price so far. Across the 4 methods used, there is a very wide range of outcomes, from $28 to $71. Both the average and the median of these 4 values are around $50 per share. Let's see how that compares to the current share price at the time of making this video, which is $40. If $50 or even $65 or $71 is an accurate estimate of the value of the share, then the current share price in the market would be undervaluing the share. If. To reduce my forecasting anxiety, if anyone is watching this video from the future, could you please send me the latest Verizon share price via a time machine? It will greatly assist me in making the right choice of whether to buy, sell, or hold Verizon shares. Let's review some of the share price dynamics which could potentially make us revise the estimates in our discounted cash flow model. Over the past 5 years, the share price has been as high as $60 and as low as $30. Verizon stock has dropped significantly in the second half of 2022 and in nearly all of 2023. Investors seem to have had concerns about the company's competitive position, debt levels, interest rates, and the potential health impact of legacy lead-sheeted cables. In late 2023 and early 2024, the shares recovered to the $40 level. An important data point here is the dividend yield of 6.7% at the bottom. This could be a very important factor in the decision-making of investors, who might actually ignore DCF analysis altogether and solely focus on dividend yield. The question here is, does the company generate enough free cash flow to be able to afford a total dividend payout that has grown to $11 billion in 2023 and use the remainder of the free cash flow for debt reduction? For my part, as a buy and hold shareholder of Verizon, the answer to that is an optimistic yes. But I do admit that I am only human. If you build a DCF model as an existing shareholder, on the one hand, you have an incentive to dig deep even when it gets boring. And on the other hand, you might be putting too much emphasis on those pieces of data that could confirm that you have made the right choice to invest. I hope you enjoyed this guide to discounted cash flow valuation. Here's the summary of the very practical tips that we discovered when building an example of the discounted cash flow model. Check for changes in consolidation, acquisitions or divestments. Revenue mix is important. A company's P&L might have some very specific line items. Understand the one-off special items. Express key metrics as percentage of revenue. The effective tax rate can be very company specific and very different from the statutory tax rate. For those line items that really matter, dig deep. Tie out your historical model data with the source documents. The 10K annual report, sections 1A and 7, can help on your revenue and gross margin percentage estimates. If you can employ multiple methods for a very important calculation, then do so. Understand the influence of the terminal value on your valuation.